Gear purchases. Should you expense them or should you depreciate them? If you just dropped $5,000 on a new camera body, you might be wondering, how do you get the best tax benefits from this? So let me show you exactly where to use each of these strategies. My name is Travis Reynolds, I am a CPA, and I help photography studio owners run more profitable studios. Alright, we all know the routine. So you need some new gear, maybe your camera body is starting to show its age and you're upgrading to that lens you've always been eyeing on for about 2 years now. Or you're finally investing in that lighting setup that'll take your studio to the next level. The question isn't whether this is a legitimate business expense, it obviously is. The question is, how do you write this off on your taxes? Most photographers I talk to think it's simple. You buy the gear, you deduct it, and you're done. But when you're running a 6-figure studio, there's actually a strategy involved here, and the choice you make can significantly impact your taxes. So let's break down what we're actually talking about. When you expense something, you're deducting the full cost in the year you bought it. You spend $5,000 on a new camera, you write off $5,000 this year. It's simple, it's immediate, and you're done. When you depreciate something, you're spreading that deduction out over several years based on the useful life of that asset, which is typically 5 years. That same $5,000 camera might be written off over 5 years at $1,000 per year. Now your first thought is probably, why would I ever choose to depreciate when I can just expense all of it right now? And that's a great question. And for a lot of purchases, you're right. Expensing makes total sense. But there are situations where depreciation is actually the smarter play. So let me explain when and why. First, let's talk about Section 179. This is the tax code provision that lets you expense equipment purchases rather than depreciating them. For 2025, you can expense up to about $1 million in equipment purchases under Section 179. So if you're a photography studio owner buying cameras, lenses, computers, lighting, whatever it is, you can generally deduct the full amount. So with all these options to expense equipment right away, when would you ever choose to depreciate instead? And here's where the strategy comes in. It all depends on your income and your tax situation in the year that you make the purchase. Let's say you had an incredible year. You booked 30 high-end weddings, you had several big commercial clients, maybe you launched a successful workshop. You're projecting that you'll make $200,000 in profit this year, and that's amazing and congratulations. But that also means you're in a high tax bracket. Every deduction you can take this year saves you a ton in taxes. In this scenario, expensing your gear purchases makes total sense. You want those deductions now when your income is high and your tax rate is high. That $5,000 camera saves you maybe $1,500 to $2,000 in taxes when you expense it in a high income year. But now let's flip the script. Let's say this year has been slower. Maybe you had a few clients postpone, or you took time off for personal reasons, or you're in a rebuilding phase. Your profit this year is only going to be around $70,000. You're in a lower tax bracket, and if you expense that $5,000 camera this year, it saves you maybe $1,200 in taxes. But what if next year you're projecting a huge year? What if you've already got 20 weddings booked for next year and your income is going to spike? In that case, you might be better off depreciating that camera over 5 years, so you get deductions in those higher income years ahead. You're essentially moving tax deductions from a low income year to a high income year when they're worth more. Here's another scenario. Let's say you've had a good year that you've already sitting at a very low taxable income because of other deductions. Maybe you made investments in your studio space, you hired employees, you had a lot of business travel, your taxable income is already going to be minimal. Taking another big equipment deduction might not even help you this year because you don't have much income left to offset. In this case, depreciating that equipment lets you save those deductions for future years when you'll actually benefit from them. You're being strategic about when you use your deductions rather than just take them all in year one when they might not even matter. Now here is where it gets interesting for studio owners. When your business is making good money consistently, you need to think about tax planning across multiple years, not just the current year. It's not about minimizing taxes this year, it's about minimizing taxes over the long term. Some studio owners get so focused on reducing their tax bill this year that they expense everything possible. They get their taxable income down to almost nothing, and then they have a problem. They can't get approved for a mortgage because their income looks too low on the paper. Or they can't get a business loan because their profit looks tiny. Or they're trying to sell their business and the financials look weak because they've been so aggressive about minimizing profit. This is where depreciation can actually be your friend. By depreciating major equipment purchases instead of expensing them, you're showing higher profit on your books while still getting tax deductions spread out over time. Your business looks more profitable to lenders, to potential buyers, and to anyone looking at your financials. Let me give you a real-world example. Let's say you're buying $15,000 worth of equipment this year. You're getting a new camera body, a couple of lenses, a new computer, lighting upgrades. If you expense all of it under Section 179, that's $1,500 in deductions this year. If you depreciate over 5 years, that's $3,000 in deductions per year for the next 5 years. If you're planning to buy a house next year and you need your business's income to look strong for mortgage approval, depreciating might make more sense. Yes, you pay a bit more in taxes this year, but next year when you're applying for that mortgage, your business income looks $15,000 higher. That could be the difference between getting approved or denied. Now I know what some of you are thinking. Can't you just choose to depreciate some equipment and expense other equipment in the same year? Yeah, absolutely you can. This is where working with a good CPA becomes crucial. They can help you mix and match strategies based on your specific situation. Maybe you expense smaller items and depreciate the big ticket purchases, or maybe expenses everything this year except for one major purchase. There's flexibility here. You're not locked into one approach for everything. Here's another factor to consider. The type of equipment matters. Some gear holds its value better than others. High-end camera bodies, certain lenses, these depreciate in real life over time. The tax depreciation schedule is actually trying to match the real-world loss in value. But some equipment like quality of lighting gear or certain specialty lenses might hold value really well. From a pure tax strategy standpoint, this doesn't change how you can depreciate them. But from a business planning standpoint, it might influence your decisions about what gear to buy and when. One more thing that trips people up. If you're going to depreciate equipment, you need to actually track it properly. You need to know what you paid, when you bought it, what depreciation schedule you're using. This isn't complicated, but it requires actual bookkeeping. You just can't wing it. Your CPA will need this information to file your taxes correctly year after year. This is another reason why some photographers just expense everything. It's simpler, you buy it, you deduct it, you're done. You don't have to track depreciation schedules for 5 years, and honestly, for a lot of smaller purchases, it's the simplicity that is worth it. A $500 lens, just expense it, don't overthink it. But for major purchases, especially when you're buying multiple pieces of equipment in 1 year, it's worth having a conversation with your CPA about the best strategy. They should be asking you about your income projections for next year, your goals for how profitable you want your business to be, and whether you're planning any major personal financial moves that require showing higher income. If your CPA isn't asking these questions, you might need a better CPA because this is exactly the kind of strategic tax planning that separates six-figure photography business owners who are just getting by from those who are building real wealth. Here's the bottom line. Section 179 and bonus depreciation are incredibly valuable tools that let you expense equipment immediately. For many photography studio owners, especially in high-income years, expensing makes perfect sense. Take the deduction now, reduce your taxes now, and move on. But don't assume that's always the right answer. If you're in a lower income year, or if you need your business to show higher profit for another reason, or if you're doing long-term tax planning across multiple years, depreciation might be the smarter play. The key is making an intentional choice based on your specific situation, not just defaulting to whatever seems simplest. So, if you found this helpful, smash that like button and subscribe for more tax strategy content for photography business owners. Drop a comment and let me know. Do you typically expense your gear purchases or do you depreciate them over time? I'm curious what most of you are doing. Remember, every major business expense is an opportunity for tax strategy. Don't leave money on the table by not thinking it through your options. Make intentional choices that serve your business both now and in the future. So I'll see you in the next one.